We're getting close, I'll tell you, we are. So we've got to deal with the beginning and ending inventory, and there's a difference. There's always more or less ending inventory than beginning. And remember how it has an effect on your cost of goods sold. So we've got to make an entry in the general ledger for that to deal with that difference. Okay? Yeah, no. This is in the book. If you like to try and memorize things and learn how to do this, go for it. But I recommend using the common sense approach more than the memorization approach. All right, here we go. Close the revenue accounts, close the expense accounts, close the drawing account, close the cost of goods sold accounts. Okay? And that's the new one. But really, they're debit accounts, so you would close them like an expense account, except for the beginning and the ending inventory, because where does the inventory account sit? Is it in the income statement? Inventory is an asset. Your purchases, your freight in, your returns and allowances, those are in your income statement, and those are temporary accounts that get closed. But beginning and ending inventory, your inventory account's in the balance sheet, and it's a permanent account. So all of a sudden, we've got to make an adjustment in a permanent account as part of closing. But it's the only one. Okay? So, I'm going to kind of skip through these because they're the ones you already know, and I'm going to focus on just the inventory adventure. But just real quick, so all of your sales related accounts are all credit balances. You got to debit them to make them go to zero. So you credit income summary, right? We all understand that. All of your expense accounts are debit balances. You've got to credit them to make them go to zero, and you debit income summary. Good? In the old days, the difference between those debits and credits was net income, right? Revenue minus expenses, net income. Now we've got this difference in inventory. And unless you account for that difference, your debits minus your credits don't equal net income anymore. So that's why we're doing this. We're 9 minutes. Okay, we're on. So here's your income summary account. Now, remember what we just walked through. We took our credits, balances, and we debited them, and we posted a credit to the income summary. We took our debit balance expense accounts, we credited those and posted a debit to income summary, right? To transfer the balance. In the old days, in Chapter 6, that's what your income summary looked like. Notice what's going on up here above. I've got 52,000 and 47,000 over there. This is our beginning and ending inventory. And what we're doing here, I want to see if they're going to help me out here. No, they're not. Okay. Here's what we're doing to make the adjustment for the difference in beginning and ending inventory. We're going to have to slide over here. Remember our worksheet? We've got all of our accounts listed. We're going to have cash, accounts receivable, inventory. And there's a trial balance with debits and credits. And we're going to have adjustments, debits and credits. And then the adjusted trial balance with debits and credits. So in this instance, the inventory had a beginning balance of $52,000, right? So I have inventory of $52,000. And I know my ending inventory is $47,000. So I'm going to come over and post an adjustment, and we're going to do this instead of just adjusting for the difference, which is what, $5,000. I'm not going to adjust for the difference like you do on all the other adjustments. I'm going to take this balance to 0. I'm going to post a credit here of $52,000. Credit here of $52,000. Debit to income summary. Notice I didn't show it. Let me show it. Income summary of $52,000. So this balance is 0. You remove your beginning inventory. Then I'm going to post I'm sorry, I'm looking in the wrong place. I'm getting tired this late at night. Then I'm going to post a debit of $47,000 to put the ending inventory balance in the account. And I'm going to post the corresponding credit to income summary. My fault. Okay, so there's 2 steps here. Remove the beginning balance, post it to income summary, add the ending balance, post it to income summary. So my adjusted balance over here is $47,000 debit. Okay? You end up in the same place as if you had just posted a $5,000 credit adjustment. So why am I doing this and leaving the debit and the credit? So I can track it. Remember our cost of goods sold section? It starts with something called beginning inventory, and it ends with something called ending inventory. I've recorded them on my worksheet so that I can complete. Remember, the worksheet's a tool, and we can go to it and pull everything we need to prepare the income statement, statement of owner's equity, and the balance sheet. So by making the adjustments where I show both the beginning and the ending here, I can still use the worksheet as a tool where I can get all of my information from one source. So I can go to it and say, well, my beginning inventory was 52 and my ending was 47. I know that based on debits and credits. I could also go here and kind of cheat it. Okay? But that's why we're doing it this way. And that's why when you come over here on the trial balance, that's why when you come over here to the income summary, you've got this $52,000 debit and $47,000 debit that we didn't have before when we were not using inventory. Okay? You had a question?
Yeah, so this adjusting entry is done at the worksheet level too, not at the drawing?
This is done at the worksheet level, adjusting for the beginning and the ending inventory. This is the new adjustment that you've got to do. Okay? And notice, if I took 56.8 minus 51, or 512, 568 minus 512, I would not end up with net income. I'd be off by $5,000. So my net income that I would normally close to the owner's capital account would be wrong, and my owner's capital account would not match the income statement and the statement of owner's equity and the balance sheet that I just prepared. So now that I've got the debits and credits for the beginning and the ending inventory in here, and I total the difference, notice that ending balance in my income summary now does match the net income from my income statement, if I can find it. Come on. How far back do we have to go? Forever. See, it does match the net income from my income statement because I've accounted for that $5,000 difference between beginning and ending inventory. Okay? So when you close out that income summary and you take that $51,000 balance to the capital account, your capital balance now ends up correct. And your general ledger matches the income statement and the balance sheet and the statement of owner's equity that you just issued to the world. Right? This is the Evelyn Wood version, for those of you.
Net income total should equal the income summary.
Yes, remember chapter 6, always, the total balance in this account ended up being net income from your income statement. And remember, net income, you can check it against the net income number that you're adding to beginning capital on the statement of owner's equity. Okay, good. Here's your entry to make it go bye-bye. And then you close the drawing account to capital, and you're good. And you post the...
So you first do cost of goods sold, and then the drawing.
You calculate the cost of goods sold on the income statement as you're preparing it. But on your worksheet, you're making this adjusting entry beforehand.
You do this adjusting entry before you declare.
Yes, yes. Okay? And then remember that you've got to post all of those closing entries that we just did to the general ledger. Okay? And once you're done, you prepare a post-closing trial balance, and the only balances you have are all your balance sheet accounts, your permanent accounts, and your temporary accounts all are 0, and you're in balance. As long as you're in balance, you're good and you're done. Okay?